Hey everyone, and welcome to today's Explainer. We're putting on our investment analyst hats right now to do a deep dive into United Parks and Resorts. You probably know them by their ticker symbol PRKS. We're looking at their highly debated Q1 2026 earnings report today. Now, if you evaluate leisure stocks or you're always on the hunt for intrinsic value, you already know this first quarter report stirred up a ton of noise in the market. I mean, we saw some pretty significant top-line pressures that would absolutely scare off a casual observer. But, as we're going to see when we look past those flashy headlines, management is actually making these massive, really aggressive, value-driven moves behind the scenes. And honestly, those actions signal a completely different story about the underlying health of this business.
To really wrap our heads around the central dichotomy of this quarter, and frankly why a value investor might be salivating right now, you've got to consider this dynamic. United Parks reported a headline net loss of $34.1 million for the quarter. Now, normally, a widening loss like that makes management panic, right? They pull back, they conserve cash, they play it safe to protect the balance sheet. But actually, scratch that. They didn't do that at all. Instead, they slammed on the gas and bought back nearly 4.4 million shares of their own stock through early May. So you have to ask yourself, why would a company experiencing a top-line contraction be so incredibly aggressive in retiring its own shares? Well, that's exactly what we're going to figure out today.
All right, so here is the game plan for how we're going to unpack this and find the true intrinsic value of the business today. We'll hit 1, the Q1 headline miss, 2, weathering the attendance drop, 3, silver linings in guest spending, 4, doubling down on share buybacks, and finally, 5, looking ahead to summer.
Okay, Section 1, the Q1 headline miss, unpacking the top-line contraction. We really have to understand this bearish data before we can appreciate the underlying resilience of the business.
So here's the big scary number that grabbed all the financial headlines. A stark $34.1 million net loss for the first quarter of 2026. And yeah, this was a notable widening from the $16.1 million loss they posted in the exact same quarter a year earlier. Operating expenses, SG&A costs, depreciation, they all ticked up. So on the surface, the profitability profile for the quarter undeniably weakened. And that is exactly what spooked the broader market.
When looking at the top line, revenue contracted by about 3%. In Q1 of 2025, they brought in $286.9 million. But this year, that number dropped down to $278.3 million. So we're looking at a miss of about $8.6 million year over year. Now look, in the theme park business, revenue is heavily dependent on just getting bodies through the turnstiles, right? So to really understand this revenue dip, we have to look a lot closer at those attendance figures.
Moving on to Section 2, weathering the attendance drop. What actually kept guests away? Was this a sudden deterioration of their economic moat, or just some temporary headwinds?
Now, the breakdown of these numbers is where the real story begins to take shape for a patient investor. We saw a total attendance decline of 171,000 fewer guests compared to last year. That's a 5% drop. Ouch. But wait, listen to the specific causes. Management noted that unfavorable, just absolutely extreme weather across most of their markets caused an estimated drop of 140,000 guests. On top of that, some softness in international visitation accounted for another 80,000 guest shortfall. So let's do the math here. 140,000 plus 80,000 is 220,000. That means if you just adjust for the crazy bad weather and the temporary international softness, domestic organic attendance would have actually grown by more than 1%. The core demand was definitely there. The sunshine, unfortunately, just wasn't.
Which brings us to Section 3, silver linings, guest spending. Because despite the stormy weather keeping some folks at home, the ones who did show up opened their wallets in a major way. The absolute standout metric here is $40.62. That is the record-breaking in-park per capita spending for the first quarter. That represents a really robust 5.3% increase year over year. This is huge, guys, because it tells us their pricing power is totally intact. Once guests are actually inside the gates, their appetite for food, merchandise, premium experiences, it's stronger than ever. The product mix inside the parks is working beautifully.
When you break down the math for the overall guest value, yes, admission per capita dipped just a tiny bit, down 0.5% to $45.81. But because that in-park spending surged by 5.3% to that record $40.62, the total revenue generated per guest actually increased. It went up 2.1% to $86.43. They are successfully extracting more value from every single visitor. That surge in food, merchandise, and in-park upgrades just completely wiped out the slight softening in upfront ticket yields.
And honestly, even more importantly, look at the forward indicators.
Deferred revenue, which is basically just cash they've collected for services they haven't provided yet, climbed over 4% to $203.8 million. Why? Well, because paid pass sales absolutely surged. They were up roughly 10% during the first quarter, and that momentum actually accelerated to a 12% increase right through the end of April. This matters tremendously for future cash flow visibility. It shows that despite a really wet and gloomy Q1, guest commitment for the rest of 2026 remains incredibly strong. Consumers are literally locking in their annual passes right now for the peak summer season.
Let's move to Section 4, doubling down on share buybacks. This is where we see capital allocation in action. I want to read this quote directly from CEO Mark Swanson because it really anchors the entire investment thesis right now. He said, and I quote, "We strongly believe our stock is materially undervalued. This action emphasizes the strong cash flow generation of this company. Management isn't just offering lip service here, folks. They are showing unwavering confidence in the intrinsic value and cash-generating ability of their business. They are looking right past that Q1 headline noise."
And here is the sheer magnitude of that conviction. They didn't just buy a few shares to show support. No way. They deployed a massive $157.5 million to retire roughly 4.4 million shares between the start of the year and early May. To break that down, they spent $92.7 million during the first quarter itself, and then, right after the quarter closed, they kept right on buying, dropping another $64.8 million. They are aggressively, and I mean aggressively, shrinking the share count.
Furthermore, they still have a ton of dry powder left. There is approximately $198 million remaining on their $500 million share repurchase authorization. Management has essentially put a floor under the stock, so the crucial point here is they plan to keep buying if the stock remains at these levels. It's basically a massive wealth transfer to remaining shareholders, assuming the business rebounds in the summer.
So let's move to Section 5, looking ahead to summer, the catalysts for the peak season where United Parks expects to make up for that lost ground.
The company has lined up a really compelling slate of growth drivers. They're rolling out a completely revamped marketing plan, highlighted by a brand new national SeaWorld campaign. They're launching outstanding new rides and attractions, supported by an expanded summer concert lineup. On the corporate side of things, they expect to ink over $15 million in sponsorship deals this year alone, aiming for a longer-term $30 million target. And they're backing all this up by deploying between $175 million and $200 million in core capital expenditures to ensure the parks look and operate flawlessly. Every single one of these initiatives is designed to directly boost attendance and drive EBITDA, or core operating profitability, much higher.
So, we have to ask the ultimate question, right? Are these summer catalysts and rising guest spending trends enough to turn the tide for PRKS? We've seen the weather struggles in Q1 for sure, but we've also seen the incredible pricing power, the surging pass sales, and management's super aggressive capital allocation through share buybacks. It's ultimately up to you to weigh the Q1 turbulence against this underlying financial data. Thank you so much for joining me to unpack this explainer. Keep an eye on those turnstiles this summer, and keep learning.